Imagine the house is fine. The roof is still there. The street is quiet. Then one letter arrives, and suddenly the bank, the buyer, and the value of the home all start asking the same question: can this place still be insured? For decades, insurance made disasters financially boring. Many people paid into one pool, and rare losses were spread around. But when fire, wind, flood, and rebuilding costs all rise together, the pool stops feeling like a pool. It starts feeling like a warning system. The U.S. Treasury's Insurance Office found that from 2018 to 2022, homeowners in the highest climate risk zip codes paid about 82% more than homeowners in the lowest risk zip codes. That is not a small surcharge. That is a map of risk turning into a bill. The GAO later found the same pattern in another language. Homes with high wind risk can face much higher premiums than comparable homes with medium wind risk. The weather does not stay outside the spreadsheet. It walks into the mortgage payment. This is why insurance matters more than most people think. A mortgage usually requires coverage. If coverage disappears, refinancing gets harder, buying gets harder, and selling can get strange. The insurance market becomes a silent gatekeeper for the housing market. When private insurers retreat, state-backed plans can become the last resort. They keep some homes financeable, but they also concentrate risk in a place taxpayers and remaining policyholders may eventually have to support. California is the example people notice first, because wildfire risk is visible. But the bigger lesson is not only California. It is what happens when a backup market starts acting less like a backup and more like infrastructure. On the coast, the pressure looks different: hurricanes, storm surge, wind lawsuits, roof replacement costs, reinsurance costs, and a chain of bills that eventually land on the homeowner's kitchen table. A higher premium is not just an insurance problem. It changes monthly affordability. It can change who qualifies for a loan. It can change which buyers can bid. And when enough buyers step back, it can change the price of the neighborhood. Dallas Fed researchers connected rising premiums to real household decisions: where people move, which mortgages get stressed, and how a $1,000 insurance increase can push financial pressure into the rest of the economy. The strange part is that this new map is not drawn with borders. It is drawn by premiums, deductibles, non-renewal letters, reinsurance prices, and the places where companies decide the old math no longer works. And when private risk gets too expensive, public systems get pulled in. Subsidized coverage, disaster aid, state plans, building codes, infrastructure spending, the bill does not vanish. It changes address. There are only a few serious choices. Harden the home. Price the risk honestly. Limit where rebuilding keeps repeating the same loss. Or build bigger public backstops and admit what they cost. Some states are trying to pull insurers back with new rules, better rate approval, mitigation credits, and reinsurance reforms. That can help. But the central question remains: can the market return without hiding the real risk? This is the uncomfortable ending. A home is not only a structure. It is a contract with risk. If that contract becomes too expensive, the market will still find a price. The question is whether families find out before or after they buy.